Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Last week's action saw a fairly narrow range, but we saw the market surge right on the close on Friday, closing at the weekly highs. This has set up the tone for a further expansion as we come into this week. The market's going to be focusing on earnings. We have Netflix, the banks, retailers, as well as a few airlines. There's going to be plenty to digest this week as it unfolds. We also have some economic reports that I think are going to be important. We have CPI coming out on Tuesday, housing starts. We'll also see the unemployment claims come out on Thursday, which have been a focus for the markets. But the number to watch will be the continuing claims, which dropped to about 18 million last week. So we're likely to see that continue to decline. If it declines substantially, this could end up to be a positive. But for sure, market sentiment remains very positive. My expectations are that we're going to see an expansion over the next couple of weeks as we move above the 3,200 level on the S&P, which I'll go in details here in a few minutes in the technical section. All the reports that are coming out on earnings this week are expected to show approximately a 40% drop in earnings. Also, the forward-looking statements are likely to be ugly, but everybody knows that. It's all priced in. Virtually everything that could be bad is already priced in. I don't think there's any real surprises likely to happen. So as we go into this week and for the next subsequent weeks moving forward, we're going to see some terrible fundamentals. But as I continue to suggest to you is that the fundamentals are looking in the rearview mirror. Every metric we're seeing is what's already happened. Market participants are going to continue to expect to see the economy open up and continue to see more activity as we go forward. There was a lot of news that came out around COVID last week. There was some minor reaction, but market participants continue to shake this off. Let's take a look at the charts and see how this week is setting up. Before going into the technicals, I want to review the output of the database. We continue to see more intermediate traction on the models. The mutual funds have moved up to 58.95%, equities 48.79%, and ETFs at 51.49%. You see we had the huge spike last week. This week has been much more moderate, but we did see a net 482 new buys. There were roughly about 900 total, but this represents the optimized models or the best models for the symbols that release the new buys. As we look down at below, we see that the percent bullish is at 48.9 on equities. I'll go through the broader database here in a minute on the WaveTech research tool. As we look at the rotation here, going down below and looking at the individual groups, you can see more of the activity and where some of the spikes are in the database. We're seeing a gradual adding on to the net positions as the weeks go by. If we close above 3,200 coming into this coming week, we're likely to see further expansion in the bullish percent. As we review the output from all of the models, you'll see that the daily models had roughly about 220 new buys, only about 70 sells, so we have a net bullish percentage here as the database ticked up from around 67%. On a weekly basis, there was a much better rotation. We saw 472 new buys in 1-2, 418 new buys in 3-2, pushing the overall weekly percentage to 59.53. As I've been discussing over the last couple of weeks, believe this will get up to around 64 to 68%, the possibility of getting to 72% if we continue to see this rotation go on, which all the technicals suggest we will, as I'll go through here in a minute. Everything that is coming out of the database right now, on the intermediate, it is telling us that we're continuing to see traction and a new intermediate term trend is continuing to unfold. As we look at the S&P cash, the market did surge, closing at 3185.04. The high for the week was 3186.82. this high was printed in the last hour of trade on Friday. So the trend expansion continues. The expectation for today is R1 is at 31.96, R2 32.10, and then 32.23. The support S1 31.73. It doesn't look like it will be hit, but I'm expecting the worst case in S1 R2 session for today. As we review the weekly, you'll see that the market grid suggests that R1 is 32.15, R2 is 32.49, and then R3 is 32.83. Now, I've been discussing this over the past several weeks that there is about a 60% probability that the market will move to the 32.80 level, and at that point we could see a hesitation in this trend. It will depend on what type of configuration we get on the shorter term charts, whether we'll be able to move through that area. You can see the RXT, or the extreme for the week, is 33.14. On the downside, 31.54 is S1. Worst case again on the weekly grid is a S1 R2 type move. It doesn't look like to me we're going to see much downside unless something happens overnight to invert what we're already seeing in the futures. Switching over to the futures, on the daily chart, we've seen a move above R1 at 31.92 with an overnight high of 31.99. As in the cash, 32.08, 32.23 is the likely target. The weekly grid also confirms, even on the futures, that the R3 target is 32.80. R2 is 32.46, so a range of expectation for this week, 32.46 to 32.80. The only thing that will negate this would be a penetration of 31.46, which is the S1 number on the futures. I don't see that happening, but if that does get penetrated, then that will negate that R2, R3 hit. We'll most likely see an R1, S2. The probabilities for that are only about 30% at this time. Going to the NASDAQ Composite Cash Market, I've been talking about us hitting the 11,000 area. Looks like this is a high probability for this week. The current market grid shows R1 at 10,727, at R3 right at that 11,000 level at 10,974, and the RXT 11,085. S1 10,507. Looks like should be an S1, R2, maybe an R3 type market this week. Just like in the S&P, if we were to penetrate the S1 number, then we would trade down to S2, which would be 10,883. Only 30% probability at this time for that to occur. Looking at the NASDAQ weekly futures, you'll see similar numbers. R2 is 11,121 on the futures. R1 is 10,971, currently trading 10,875. Looking for the markets to open about 38 handles higher right now. We're a couple hours away from the London Open at the moment, but the configuration looks like we're definitely going to continue toward this upper end of the range. RXD is 11,405. Everything across the board on the futures, on the S&P, the cash, as well as the NASDAQ cash and futures, all look like a worst case S1, R2 market this week. The next market to cover will be the 10-year notes. This is the daily chart. I discussed last week that I thought we could get down to around the 6% level. We spiked below that at 573, and now we bounced back and had a nice reversal on Friday. If there's some follow through, get above the 658 level, then we should start to see further recovery toward the 683 to the 672 level. The key to understand here is that the Fed wants to see a steepening in the yield curve, especially at the intermediate and the longer term, which would be the 10 and 30 year. We did see some contraction this week, but this will be a a chart that I'll be watching during the week, looking for the yield curve to flip around here and start to steepen back up. If the targets I just discussed in the 10-year are hit, that will be the case here. Reviewing the weekly 10-year, this suggests that we're going to be locked under the 760 level, even if there is a rally for some time. We're looking down a minus 5.63, ppm down a minus 1.37, ppm 1 is still down a minus 0.13, and that resistance point's at the 686 level. So the most we could expect here is to see this move up into this range, 686 to 720. Next market to look at is the US dollar. It continues to drift slightly lower. The PPM suggests there's still substantial amount of downward pressure above the market, but the configuration suggests that we're getting very close to a bottom, with the downward part of the grid being around 96.22. As long as we remain above that level, we're likely to see a move back up into the grid toward the 97.40 to 97.96 level. I continue to believe that this market is in a consolidation phase, and this is something that I believe the Fed will be targeting. They need a stable dollar to go forward based on the actions that they've taken over the past several months. If the dollar were to fade too quickly, this would disrupt a lot of things that the Fed has in play right now with QE and expansion of the currency base that would really cause havoc in their overall strategy and what they're doing for the economy. One of the new things we might see is them come in to intervene if the dollar starts to slip. The Fed is going to continue to be in this market looking to stabilize it well above the 95. The worst case is the 93.80 level, which would put us down to the 200-week moving average. The final market to cover tonight will be gold. As I've discussed over the past several weeks, we continue to climb up in this channel. The expectations are for a move this week potentially toward the 1824 to 1836 level. The extreme would be at the top end of the grid would be 1846. Support on the downside continues to be between 1779 and 1767. There has been some dissipation of some of the upward pressure or the momentum on the upside, but ppm 1 is still at 0.49, ppm 2 is at 0.39. As I review the daily graph, you can see that configuration is much tighter and the ppms are in a neutral phase, but they are poised to break out. A close above the 1820 level will be enough to trigger us up into that upper end range that I just discussed on the weekly graph. This will complete the video for tonight. Thanks again for watching. Don't forget to subscribe and like these videos.